Now, without further delay, let's begin today's ETF Education Series Multi-Share Class ETFs Unpacked webinar. I'd like to introduce Douglas Yones, Head of Exchange Traded Products at the New York Stock Exchange. Douglas, the floor is yours.
Well, thank you so much. Hello, everyone. Thank you for joining us today with another educational opportunity brought to you by ETF Central, the New York Stock Exchange, the home of ETFs. As mentioned, I'm Douglas Yones. I head up the ETF business here. I'm excited to be bringing to you today's event. It feels like multi-share class ETFs are the topic du jour. We seem to be talking about them in numerous individual meetings across me and my team. We thought it'd be a great idea to pull in the experts and put together this webinar today. As mentioned, we are recording this. This will go live on ETF Central, and it is the latest certified ETF advisor webinar, which means if you're a CETF, you can register for CE credit. And we welcome anyone who's dialed in who is not yet a certified ETF advisor or CETF. You can do that by going to etfcentral.com, click on the ETF Institute. You'll find out all about it, or reach out to me individually. I'm happy to talk you through it. Now, today's webcast is titled Multi-Share Class ETFs Unpacked. We are going to focus on the multi-share class structure. We'll talk about how it works. We'll talk about the considerations. Everyone always talks about the positives. We'll do that, but we'll also talk about some of the considerations you'll want to consider as you're starting to think about this. We're going to, of course, talk about the numerous filings that are out there and sitting with the SEC in an attempt to receive exemptive relief. Thank you again, by the way, to Rob Kenyon. Not sure if you're dialed in, but we do appreciate your efforts while you were with Perpetual to get this all started and launch the first application. For those interested in consulting services, Rob is now consulting some of the applicants thinking about multi-share class. Reach out to him or me. Happy to connect you up. As mentioned, we are taking questions. Feel free to fire them in at any time. I will try and moderate them throughout the conversation today, so don't have to wait till the end. Please send them in. I'm going to do my best. And then final, for the media, we know there's a lot of media in attendance. We did not stop you from attending. We are friends of the media, but at the same time, I've asked my panelists to not worry about scripting every answer and just have a conversation. So please, if you are media and you plan on using any quotes, please reach out to us so we can make sure that they're clean and updated, all that. Okay, with that, I'd like to begin. I'm joined today by friends of the New York Stock Exchange, and let me quickly introduce them. Ben Slavin's Global Head of ETFs at BNY Mellon. Timothy Huver, Managing Director of U.S. ETF Services at Brown Brothers Harriman. Jeffery Sardinha, he is Head of ETF Solutions at State Street. Last and certainly not least, Morrison Warren, partner at Chapman Cutler. Gentlemen, thank you all for being here today. Let's get right into it. So, Jeff, I'm going to call on you, if you don't mind, to help us set the stage. So, you know, this year we've got over 24 brand new asset managers that have launched their very first ETF. What have you seen in terms of your business, the growth rates across the ETF industry? What type of firms are entering the market right now?
Yeah, thanks, Doug, and thanks for having me. So I'd start out by saying we're seeing all types, right? We're seeing everything from small SMAs that are looking to expand their distribution channel all the way up to the last handful of managers on the top 50 active mutual fund manager lists that still do not have ETFs. I think at last count, we're at like 36 or 37 of them, either have proprietary products or manage some for others. And I think based on the filings that we've at least seen out in the industry, I expect a couple more to fall from that list. So from a type of firm, it's all kinds. I think the interesting part about like what we're seeing come to market is kind of the skew towards active. We're seeing a skew towards active from a launch perspective. And I think part of that is because that's where folks see kind of the white space, right? If I look at the top 7 managers, like historical legacy ETF managers that are mostly in the passive business, and I kind of compare those behemoths to the top 7 who are in the actively managed business within ETFs, there's really zero overlap. Which is a good thing, I think, for the overall industry. So you can pick your metric. Launches, flows, all of that we see trending towards active, at least based on the size of the actively managed marketplace today. I really think there's probably like 2 stories out there right now from a flow perspective. One, active, which I've said a few times now, and the second I'd say is still kind of super low cost building blocks. Like those aren't going away.
Yeah, you bring up a couple of interesting stats. 70% plus of ETFs launched this year. The last few years have all been active. For those that are following but looking for data, just a reminder, we do produce a monthly report here at the New York Stock Exchange. It's free. You just go to homeofetfs.com. You could sign up for our active industry newsletter. You'll see all the stats. It's everything going on in that space, all the intelligence you might need. Ben, we're starting to talk through some of the not only launch numbers, but cash flow this year has also been breaking records. Over a third of all cash flow in ETFs this year is going into actively managed ETFs. What are you seeing? Why is this happening? Where's all this coming from?
Well, again, actively managed ETFs have been the majority of new product development for the last few years. I think we've just crossed over 1,200 actively managed ETFs. So what's new is the flow rates, right? And we've seen that pick up and begin to accelerate. So right now, actively managed ETFs are around 8% of the industry. But we're seeing flow around a third of that flow is coming into these actively managed products. So if you think about it, it's been between 3 and 4 times its weight class, or punching above their weight class, just this year. And the market's evolved. We started actively managed ETFs really was about a fixed income story. And then fast forward to today, obviously equities are picking up a lion's share of that flow, and also much of the new product development has been in that area. But you also need to look underneath the hood and see where that money is going, which is quite interesting. And it's split, right? You have a lot of different products under that tent. We still see a lot of the flow going to low cost active products, and certainly several issuers like Dimensional, Avantis, et cetera, are picking up a good amount of that active flow. And then also more traditional, higher active share, more concentrated equity portfolios, also still starting to pick up flow, and certain thematic products in between also looking to generate alpha, but albeit in a different way, alongside the option-based products, also active, continuing to attract attention from investors. So it's a little bit of a mixed bag there, but there's a lot more choice in the market, and clearly investors are starting to notice, and you see those flow rates picking up.
Yeah, we're seeing the flow rates, and we're giving these outstanding numbers, but Tim, we can see the number of people dialed into the webinar. There are a lot of active managers who don't yet have ETFs. They're thinking about multi-share classes, maybe the entry point. Do you feel like the space is crowded? Somebody said to me, there's a whole lot of ETFs right now. Is there too many ETFs? How is it for a new active manager that's thinking about coming into the space?
Yeah, thanks, Doug. I would say that I think we recognize that the ETF market in the U.S. is mature, and there are some crowded segments and categories of the market. But I will say that I think the active ETF space is still relatively nascent. And Ben gave the numbers: 8% of AUM, but 30% of flow. And so we are starting to see, and I think in past years we've said time for active ETFs is near. Now we're saying the time is really now, and we're seeing that inflection point and that accelerated growth. And so, Doug, as you know, at BBH, we run an annual global ETF survey. We just published the results. If you look at the investor demand specifically in the US, 92% of US ETF investors stated that they would increase their allocation to active ETFs in the near future. 91% of investors also anticipate to expand the number of issuers that they're working with today. So we are seeing, I think, accelerated investor demand within the active space. It has led to more conversations with asset managers on how to best enter the ETF market, how can they potentially leverage the existing scale, the existing track record that they've established. And so we'll talk about product structuring here as we move forward, but those are the types of questions and types of conversations that we're having with the potential issuers that we're working with.
Yeah, and thanks, Tim. And for those that haven't yet seen that report, again, it's free. You can download it. You can reach out to any of us, go to BBH's website, and we'll be having a special coming up on etfcentral.com to really dig into the results of that global report. It's probably your plan for corporate strategy for the next 12 months. So please go get it. Available, again, free and sponsored by BBH. Tim, we've done a lay of the land. we get it. ETFs are here and growing, and they're probably the next opportunity for most active managers that are out there. Let's start talking multi-share class. So you and I, for those that don't know the history, Tim and I were fortunate enough to spend a large number of years of our early career at the Vanguard Group. We have very, very direct and personal experience working with multi-share class ETFs. We see a lot of our Vanguard colleagues, ex-colleagues still dialed in here to the webinar. Welcome. But let's get into it because not everyone really understands how it works. So would you mind starting out with a little of the nuts and bolts of what it means to run a multi-share class ETF?
Yeah, and so if you look at the existing multi-share class structure that that has been within the market under patent for a number of years, that patent obviously expired in 2023. It really was a situation where the ETF operated as a share class within a multi-share class registered investment company. And so you can think about it in many instances, the ETF was a share class that was added to an existing mutual fund portfolio. And so you can start to really think about some of the benefits that are realized through that type of structure, instant and immediate economies of scale that are generated through that, as opposed to trying to launch a standalone ETF platform or a standalone ETF. Those economies of scale as ETF grows benefit all investors across share classes. You also look at the track record and the performance history then that can be attributed or referenced through the addition of a share class, the tax efficiency that is really passed along to shareholders across all share classes within the portfolio. So tax efficiency reaching a larger number of investors through that type of structure. And I think the one that often gets overlooked, the ability to promote liquidity within the ETF. And so Doug, getting into some more of the tactical here, that creation and redemption, that delivery basket that's delivered. If you're talking about, let's say, an aggregate bond index, difficult to put out a 13,000 bond basket every day into the marketplace. And so what this allows is the ETF can have an optimized portfolio, and you can take the cash flow coming in from other share classes to round that out, track tightly to an index in the event of a passive mandate. And so it helps promote the liquidity of the ETF. And for issuers, a product agnostic approach as well, the ability to offer different funds, different vehicles to best meet the needs of unique shareholders.
Yeah, and thank you for bringing up a few specific examples, because I think a lot of times we tend to talk 30, 40,000 feet up instead of getting into the details. I see some questions coming in. For those of you asking about some of the cash flow numbers and what it looks like across the industry, again, I invite you to just go to homeofetfs.com, click on that active newsletter. You'll see everything you're looking for, or just reach out to one of us. We can go through some of those numbers. Morrison, I want to come to you. I'm sorry we haven't gotten to you, but let's start talk about the lay of the land. So I mentioned when we kicked off, a big thanks to Rob Kenyon and the team at Perpetual for really starting this. The Vanguard patent had expired. At that point, Perpetual filed the very first multi-share class exemptive relief. Can you explain what that means, why it's important, and maybe where we are today with some of the different filings that are out there?
Sure, Doug, and thanks for having me. I want to first just sort of walk through how this started. Rob had approached us, asked if we thought that exemptive relief was something that was possible. And considering especially all the things that Tim had mentioned, all the positives associated with this multi-class structure that Vanguard was able to enjoy as a result of the relief. At the time we started, the patent still existed, but clearly it was going to run off. And the idea was, yes, like why not do this? This is something that really could benefit a wide range of participants, and in particular, the folks that Rob had worked for. We approached the SEC initially, and lukewarm response. At the staff didn't really seem to want to embrace this topic at this point, but that really didn't deter the group. We had worked with a range of folks, including the NYSE and others that could see the potential benefits for the marketplace. And the idea was to submit an application. There's been, I think that this has such potential that others see it. And at this point, despite the SEC staff not necessarily encouraging applications. I think there are 14 applications that have been filed. There are a range of ways to solve for the potential issues that the staff has. We'll talk later on about those issues. But my sense is that there are quite a few folks that recognize the potential benefits. And right now at this point, the staff is providing comments and folks are trying to work through those comments. So we're moving, no time frame at this point, but it's encouraging that the number of folks have filed.
Thanks. And we're going to come back to some of those pieces because we're getting some questions on, what do comments look like? Where are we headed? Timing. So we're going to get to some of those things here shortly. Ben, I want to come over to you. We've got all three major custody banks for ETFs globally here on the line. Obviously, BNY Mellon, all three of you are managing multi-share class ETF structures today. So you're all familiar with the process and the processes. For those that aren't as familiar with the UCITS lineup of ETFs, outside of the U.S., multi-share class vehicles are not that uncommon. In fact, they're typically the norm. I was hoping you could share a little bit more about the process level of managing multi-share class. How does it work from your side, and how are you managing these types of structures globally?
Yeah, sure, Doug. I think you just said it, straight away. Multi-share class ETFs and certainly mutual funds have kind of been around forever, right? So from our standpoint, we are, certainly doing this today in other parts of the world. And you mentioned like UCITS ETFs, certainly in Europe. And the switches between the share classes are actually quite common, as it is, again, in other parts of the world. But, we see this, really impacting a variety of areas of the operation. It's certainly custody, fund accounting, and of course, all the ETF services. But there are several things that, you really need to think about from an operations standpoint, as well as from an investor standpoint. So if you think about it from an investor standpoint, really what's required? Well, honestly, and obviously, the investor's got to have a brokerage account, right? The switch trades that you need to move between the share classes must, really have the full set of instructions. ETFs only operate in whole shares only, so there's decisions to be made with, residual cash. And honestly, the ETF service provider certainly would need to enrich those instructions and work with the brokerage account wherever those shares need to be delivered or sent from or to. But certainly from an operations perspective, there's a whole host of things that we're engaged with clients on, and I'm sure probably everyone on this panel is too, ranging from how to manage, basket creations where you have only, part of the assets are impacted, which would be the ETF share class versus the mutual fund. Certainly expense allocations, which I think we'll touch on, has been a hot topic. Things like cutoff times, underlying tax lots, things that need to be sorted out under the hood, that really all, are the important decisions and structure that needs to be in place to be able to support this. And so again, the playbook is there, but I will caveat all of that and say there are some unknowns here, given exactly how the SEC is going to move, and ultimately the rules that will come out of this process leave a few open-ended questions. But certainly there's going to be some work to do as well to automate all of this and really be able to scale it out for the industry. Because you asked the question, is there too many ETFs? We can debate that question, but I think kind of wait and see if this happens. We're going to see a whole lot more. So it will require the ability for the industry, all of us, to kind of be able to scale out this, the operating model to support all this.
Thank you, Jeff. I want to come back to you around operating the model, and we had a few questions here, so maybe we can kind of incorporate a few questions here. So we have some questions around maybe explaining a little bit more about that cash flow component. So some of the share classes supporting the liquidity of the ETF. So maybe as you talk a little bit about both the benefits, but also let's start to creep into the challenges, if you will. Would you mind getting into the operational components?
Yeah, sure. So I guess first off, if you're looking at kind of comps, we talked about UCITS for a little bit. I really think Canada is probably the right comp. those are actively managed mutual funds that hung an ETF share class off of them. So to Ben's earlier point, we service these today globally. I'd say overall, there's like two ways to look at this, right? Way number one is from a custodian administrator standpoint, are your systems ready to handle what's going on? And I think the simple answer to that is yes, right? We do it today. I'm not really concerned about that based on how the process works today and how the filings have, for the most part, been written to date. That said, inside of State Street, we kind of look outside of our four walls at the health of the overall industry and the growth that we're looking for from the industry. And I think there are nuances that you need to look at. I saw somebody asked about transparency. Transparency is an absolute thing to focus on, a consideration to focus on. I think your experience managing ETFs, if you're a legacy active mutual fund manager, your experience with managing ETFs, tools, peoples, systems, etc. I think the difference between the two transfer agencies, right? You have a retail transfer agency still for your mutual fund, and you're going to have an ETF transfer agency for your ETF. And shareholder servicing is done in two different places, dependent upon the TA and the overall and underlying wrapper. And I guess one of the other things that I think goes unnoticed often is what currently is the kind of experience of the product that you're looking to hang the ETF share class off of, right? Is that mutual fund in outflows? Is it in inflows? What's the tax situation associated with that mutual fund? What's the size of it? How big is the ETF going to be that you bring over or that you hang off of it? All considerations to take into account, because I did see another question around, if the ETF is 5% of the size of the overall portfolio, how efficient is the mutual fund? And I think there are ways to try to effectuate and get across more tax efficiency, but you do have to start from a particular point in time and a particular place. And if that is with your legacy mutual fund being in outflows for an extended period of time where you've kind of worked through all your high cost lots and you're stuck with low cost lots, it's going to take some time and some work to ensure that you don't kind of give your year one ETF share class owners a bit of a bumpy ride kind of out of the gate. So yeah, I think there are some definite nuances to work on. I think it's beyond what some of the folks have discussed so far, just holistically across the industry. You've heard a lot about allocations of expenses. And I think folks think about that from a much higher level. And they're not thinking about it from an individual transaction level, right? Getting into the actual weeds on, is this transaction a benefit to both share classes? Is this transaction solely tied to a flow in one share class? And how do we mitigate the cost or the impact of that to another share class owner? So those are the type of nuances that I think the industry has to work through. At the end of the day, I think it's a math problem. I don't think it's much more than that. And then again, for administrators and custodians, we can support it today, all right, based on instruction and based on some of the allocation capabilities we all have, whether it's cross class, composite down, class up, we can all support that. But are there areas where we can kind of step in and help to automate some of that? And that's where I think a lot of us want to get our hands dirty with the industry and kind of work through all that.
Yeah, all good points. And maybe because you ended up touching on a few things, I'll close out on one more question, because we're trying to, hey, if you're out there and you're asking questions, by the way, we've probably answered 6 or 7, so keep them coming. Another good example, someone asked about the cash flow nuances that Tim brought up. Imagine you have a very large number of holdings across your entire fund. If you've got an ETF share class, that ETF basket can be much, much smaller, and you can handle the rest of the names through cash flow coming in through your other share classes. Morrison, let's come back your way. Let's get into the guts of this thing now. So there are a whole series of exemptive relief applications out there. The SEC has been starting to issue comments back. We've seen some through the perpetual filing and some others. It seems like most of the comments back can be bucketed into a few key areas. Would you mind starting to share at a high level what those items look like? And then maybe we can tackle a little bit about whether or not they're solvable.
Sure. And in general, the real concern is, is this going to cause more harm than good, right? And so the staff is worried about the tax impact that may occur as a result. Normally, not always, ETFs are more tax efficient. Will any of that be lost? There are concerns about how expenses are allocated and whether there can be an equitable division of the expenses so that one class is not disadvantaged versus another. There have been some concerns about cash, whether the mutual fund class would require cash in excess of what would be typical for an ETF, and then questions as to transparency, which I saw a question roll through. Is there, obviously ETFs have are fully transparent. Obviously, there's relief for semi-transparent, but mutual funds don't have the same level of transparency. Will something be lost as a result of pushing these two structures together? And then there's a series of questions as well as to, is this necessary, right? Can you achieve this without pushing a mutual fund class and an ETF class together? To me, those are the buckets as you indicated, Doug. I do think they're all solvable. In many cases, obviously these are funds, they have boards. Boards have the ability to evaluate whether this is a good structure. Two, there's a possibility of disclosure, so shareholders can understand what they are in for, and procedures and obviously good processes are a cure for some of these problems or issues as well.
Thank you very much. And I know we have other presenters here. It seems like some of these buckets are worth diving into a little bit. So Ben, I'm going to come to you. Let's dig a little deeper, if we can, around the idea of managing costs across share classes, because you're dealing with this today, right? Traditional regulatory frameworks require that one share class isn't harming another share class across, whether that be here in the U.S. or outside of the U.S. Could you talk a little bit about how some of those types of things are controlled for today?
Yeah, sure. And certainly, we just touched on it. Morrison had mentioned it's a key concern of the SEC. And I think, Jeff, you touched on this a little bit as well. So this is clearly a key area of focus regarding, how the shareholders are treated and making sure that's equitable. I think, ultimately there's certainly some nuance to this. And I think, you just touched on a few of the, potential solutions, certainly around boards, disclosure, but also having the appropriate operating model to be able to do all this, right? I think I like the concept of, or the tagline of, it's just math, in order to be able to make those allocations, and, ultimately establishing that allocation methodology is going to be critical. I think one of the issues, though, that's challenging the industry, and again, we've all talked about how we're supporting this today, is certainly the ability to automate some of these processes to be able to scale it out. I had alluded to that earlier. And we also need that participation from the brokerage firms as well, who are executing some of these trades, for example, to be able to, as one example, to match the order IDs to each individual creation order, right? To be able to have that matching in an automated fashion to be able to, again, scale this out. But certainly, when you look at the P&L allocations, again, it's going to impact all shareholders, certainly not just the ETF. And so that's something that we need to consider, obviously across, really, again, how they're treated across both classes. Now, I think there's one other quick question before I turn it back to you, Doug, certainly about how, really around some of the other fee considerations, such as revenue sharing, et cetera, might impact across the various share classes. Certainly, again, we need some more insight into exactly where the regulatory process is going. Certainly, there's the ability to make those accruals across the various share classes. I think, though, you do get to really think about your distribution strategy again, and how that's going to work in each individual channel. And again, certainly the mutual fund class being a very much a prime example of where you can raise assets in the retirement space, and again have the ETF share class coexist for taxable accounts. But certainly the fee considerations are going to be key, and ultimately I think that's going to be driven by the business decision by the asset manager, as well as, again, what the SEC or whatever direction the SEC might take this in terms of what's allowable again, to be able to harmonize those fees or not across the two share classes.
Yeah, I want to stick on this topic because it seems like there have been almost two different ways that people are looking at this right now. So some of the filings have said we're going to try and do a real at cost. Some of the filings have said we'll track and we'll adjust based on a certain period of time, whether it be a quarter at a time. We'll review as a board. There's also a filing, I believe, that says we're going to hold fees flat at a certain level, and then anything above that would be paid out of the advisor. Jeff, if I come over to you for a minute, can you comment a little bit about some of your clients, people you're working with, and some of that cost allocation and how they may handle the questions around impact of costs across share classes?
Sure. So I think one of the things that I'm reading or I've read in a number of the filings and in conversations I've had with a number of the issuers that are looking to get into the spaces, we're spending a lot of time talking about costs and trying to make sure that we're equitable to the underlying shareholder. But at the end of the day, if you really take a step back and you look at this overall structure, you start to see, and I think there's a decent case to be made, that there is a net benefit to every shareholder, regardless of which class you're in, versus a standalone product of that specific type of class, right? So like just thinking about this like piece by piece, some of the benefits that we see for mutual funds that we've heard many times as well, the ETF has its in-kind capability, and that's reduced costs in terms of flows and also brings some additional tax efficiency to the table. And that's all true, obviously, right? Now, on the mutual fund side, though, with their cash flows, which again, you're going to assume you have some cash flows, ETFs don't typically hold cash. So that cash flow from a mutual fund makes it very easy for a manager within an ETF to reposition kind of straight away. Like if you think about how standalone ETFs work today, if there's a repositioning needed, somebody's doing something, somebody's selling something, or somebody's adjusting a basket to be heavier in cash, that kind of automatically is done. Like you're likely going to have cash on hand. You can reposition much more frequently and much more efficiently, knowing that these two wrappers are combined under one composite umbrella with the same share of assets. I think the other thing that gets lost sometimes is the scale and track record that gets brought in. If you think about how ETFs are sold, they're not bought. Like there are toll gates that you have to get through from a sizing perspective and a timeline perspective. And some of those or most of those are going to be solved if you're bringing in a legacy product with the right amount of track record and at scale. You're going to get through some of those toll gates. So I think overall, yes, there is a consideration to sit and say, are there specific things that we do want to carve out and say, this is an ETF only expense, this is a mutual fund only expense. Your management fee theoretically should be the same across the board because you're managing the same pool of assets. But I also think there's an argument to be made that there's a net benefit across the board here by the kind of the symbiotic relationship of both classes living together under one structure.
Tim, let's start to talk a little bit about taxes. Everyone's favorite topic, taxes. There's some commentary I think out there in the industry that maybe the concerns around tax, one shareholder impacting another shareholder's tax could potentially be solved via disclosure. Do you think that's a possibility?
I think that's one outcome, potential outcome, Doug. I think you look at allocation of cost, and that's moving more towards, I think, specific allocation there in the share classes as a potential outcome. I think on the tax side, to your point, it could be solved via disclosure. Now, is that disclosure likely in the offering documents where investors are aware that that they receive certain benefits by being in a multi-share class structure? ETF investors are also sharing potentially in a tax footprint beyond just their own holding within the ETF. So I think that's one area of disclosure. And then I think still to be seen, what does the disclosure look like, the monitoring on an ongoing basis, and just the oversight there and the governance for the asset manager to ensure that that there's that each shareholder on a relative basis is experiencing the benefits of multi-share class holistically. So I think that's one area of focus. at this moment in time. I think that, it's also important to note that standalone ETFs are not immune to capital gains. I know it tends to be more of a rare occurrence, but we have seen that as well within a multi-share class structure, potentially an opportunity to harvest losses through the trading in cash and other share classes that could be used to offset, gains across the entire portfolio. So I think that's another area or topic that may get overlooked potentially.
Yeah, it's a good point. I mean, people tend to talk about the tax benefits, but it's almost as if they pretend there's never tax. That's not the case. And there's certainly taxation at the individual level. Morrison, if you don't mind, I know we haven't asked you to come here as a tax attorney, but you're certainly representing your clients with respect to some of the dialogue with the SEC. You've dealt with this across multi-share class structures today that exist. Do you think it's a possibility we may just solve the tax issue as a disclosure item?
Well, I mean, I think disclosure is important to let investors know, especially ETF investors who perhaps were expecting not to have capital gains, that they may as a result of this structure. I think it's vital, necessary. There's another side of it too, and ETFs have been amazingly efficient at coping with taxes. Right? It may be that one benefit of this structure could be allowing mutual funds that are attached to ETFs also to share some of those benefits, if in fact that can be worked out. So I think the solution is one, consideration from a board perspective as to whether this is an appropriate fund based upon the potential taxes and the way it operates to be included where you have a mutual fund class and an ETF class together. Two, disclose the potential negative impacts associated with that. Three, try to take advantage of the ETF structure and perhaps even utilize that to reduce potential taxes on the mutual fund side. It would take obviously it would take an evolution or a development as it relates to that, but this is a development and an evolution. So and we are not looking at a circumstance where this has not been done. Clearly Vanguard has been doing this since 2000. I think they have over $1 trillion, maybe $2 trillion devoted to this system, and they have one solution. There can be many solutions and considerations here.
Thanks. We have a lot to cover. We have a lot of questions coming in. Keep them coming. It's making me want to modify things a little bit. So we're going to do like a game show roundtable. We talked about all the positives. Anyone want to quickly mention the negatives or the considerations out there? I'll go quickly. Tim, any negative things that multi-share class might bring to an asset manager that's thinking about coming out in this space?
I think the process is somewhat different. I think, Doug, excuse me, for those entering the space. I'll try to be quick here, but with an active ETF, you're still looking at the same type of considerations apart from multi-share class. It's not unique to multi-share class. Scale, your ability to provide transparency, I think, is one. Capacity, can't turn off the ETF to creations and redemptions, that liquidity valve. So I think that's important. But then beyond that, you start to look at some of the topics that were mentioned here: pricing, the management fee between the mutual fund and ETF, the ongoing governance of the structure to make sure that that one shareholder is not disadvantaged versus another, dependent upon share classes. So I think you start to move into that area. I think upfront, does this belong in an ETF or should we launch a multi-share class? I think asset managers should look at the profile of investors, concentration of assets with certain investors, just what is the profile of and volatility of cash flow in and out. That can maybe give a sense for whether or not this is the most appropriate mandate in a multi-share class structure.
Jeff, it's a problem we all want to have, which is too much money flowing into a fund. But the reality, as Tim said, is if you have an ETF can't be gated. Are there other negatives that people should be thinking about?
So I don't want to, I'm going to talk about 6C11, and it's a negative question. And 6C11 is not a negative thing. It's a positive thing, right? It helped active ETFs grow. But I do want to be cognizant of the fact that the only way I see this really happening, if you're looking to gain some of the benefits that exist within an ETF today, an active ETF today, you're going to have to govern this under something that resembles 6C11. And with that means you have a lot of CIOs out there that you have to get comfortable that you're going to be fully transparent. So For sure, that is probably the number one thing, or that I've had conversations with issuers. It's how transparent do we want to be? Tim did a great job of calling out how not every strategy works in an ETF, frankly. So that's just par for the course. That's no different than it is today.
And thanks for bringing up, semi-transparent ETFs do exist. They're out there. Some have been successful. Some have struggled more on the distribution side, which we'll get to. Before we change topics, though, because we should talk distribution, we have some questions there. I want to come to you. Just Ben, did we miss anything on the considerations, negatives, anything people should be aware of?
Yeah, I think all the key points were raised, but I'll raise one other word that hasn't come up in this discussion yet, which is the topic of conversions. And I think obviously this topic has been coming up in our discussions with clients around the idea of adding a share class. And certainly at BNY Mellon, we have processed and worked with multiple clients on different conversions, but as I think many of you know on this call, certainly there's a lot of friction associated with those conversions. There's a lot of work behind the scenes, and certainly, one of the many goals is to retain those assets, and also to look at ways to make sure you can specifically retain those assets that are in retirement plans or qualified money. And so I think, this definitely offers a different approach, and we are seeing investors, who have been impacted, might actually have been better off, obviously, with looking at the share class structure. And certainly this is another consideration that we are seeing across our clients deciding, should I convert, or should I try to wait for the potential to add a share class? But again, all of these other considerations certainly apply. Such as fees, for example, and being able to have investment content that can honestly compete, raise assets, and thrive in an ETF structure still applies. But again, it is related, I think, to some degree to the conversion topic. Again, it's just part of the overall strategy, either on market entry or how to add to their existing ETF lineup.
For the person that asked about a potential multi-share class structure with semi-transparent and using that, we'd love to talk. Please reach out to us. Why not? Let's file for it. Ben, you brought up conversions. Let's just stay there. We've got a lot of questions around that. Jeff, I want to come to you. There's been over 70 mutual fund to ETF conversions already over the last few years. Well over 70 billion has converted. In most cases, it's gone pretty well. If not really well. When should someone be thinking about conversion? When shouldn't they? Does multi-share class slow somebody's project down, speed it up? What are your thoughts?
Yeah, thanks, Doug. So yeah, you're right. There's been over 70, and I think over at State Street, we've been part of probably 50 of those. So it's definitely been a big part of our business and helping the active managers grow. So number one, I guess I don't shut down any path to get into the ETF industry. I'm an ETF lifer. So I view conversion as one additional entry point. I think there is a place, a home still for conversions. Like if you have the right strategy that has the right shareholder makeup, and we think could round out an ETF platform that you already have, so a suite of products, and you're just missing that one piece, I think a conversion is a perfectly fine way to do that. I think share class gives you an alternative, which is a good thing as well. At the end of the day, like when I'm talking to firms that are thinking about entering the ETF space, one of the things I hear from all of them is our sales teams, our wholesalers, our distribution side, they're clamoring for ETFs to sell because that's what advisors are looking to buy. So I don't think conversions are going to go away. I think one thing that conversions do bring to the table is it really helps with product rationalization. Like if you start to think about launching brand new ETFs, set share class aside for a second, launching brand new ETFs, every strategy has like a minimum dollar amount to be feasible to just be able to run. Like forget toll gates, forget growth, just to be able to run. And in some cases, it's cheaper to convert a product into an ETF wrapper where you may even lose some shareholders as long as the shareholder makeup makes sense, right? Low DC to no DC, frankly, mostly taxable accounts. It's cheaper to convert that product over in some cases than it is to go find $25 million to start up a brand new ETF to be able to run that strategy until you can start to sell it. So I don't think conversions go away, but I think share classes are an additional now entry point for anyone.
Tim, is there a reason that someone who might be thinking about doing a mutual fund to ETF conversion, should they now look at these filings and should they slow their project down? What are your thoughts?
No, I think that, and Jeff touched upon that. I mean, when you look at the conversion route, it's obviously a proven route, proven path to the ETF space. A lot of benefits with leveraging track record and scale. I think that for multi-share class, distribution footprint becomes important as well, and understanding, product preferences within that distribution channel. We talked about the DC space being more mutual fund heavy than ETF in today's world. So I just think that that's an important consideration. Interestingly, started to have some conversations around launching standalone ETFs and the ability to merge at some point in the future. And is that a possibility? So that's another potential avenue because of the uncertainty that exists in approval with multi-share class, maybe a half step towards that type of model. There's also, Doug, we haven't talked about switches as well, whereas a conversion moves everyone into the ETF, multi-share class provides an ability for those that may be in a mutual fund share class today to move over to the ETF on their own terms, on their own timing. I think that's, obviously, if they have a brokerage account, whereas the conversion almost necessitates that type of movement, that's another, I think, feature of that multi-share class structure that creates a unique benefit.
It sure does, and hopefully, I'm watching the time. Hopefully, we can get into switches because I've got two more topics we need to address. So let's fire into the next one, which is the approvals process or timeline. We have a lot of questions. I love the question or comment that said, I guess you guys think this might go through, or else why hold the webinar? So well done, sir. Please keep the questions coming, comments as well. We like them. Morrison, let's go to you as our lawyer in the room. What does this process look like? What could the timeline look like? And, maybe let's compare and contrast that. I'll try and help you a little bit with some of the other new and novel structures that we've been able to get to market here at the New York Stock Exchange.
Well, to me, this is a lot like some of these other processes that have taken time, but because people believe they have value, ultimately the staff works with you and you come out with a positive outcome. Semi-transparent, you mentioned before, that obviously took a long time. There were various parties that were participating, and ultimately something was the result of that, right? And so those structures do exist. I would also say that what's happened with crypto, that process was more confrontational, obviously, with the staff, but eventually the staff on its own allowed for Bitcoin futures funds, and then Ether futures funds, and then spot Bitcoin funds, post after some litigation. But there was an evolution as it related to the thinking and then solving for problems. Here is something, the good part is we have a living example of this working, right? And it worked for a long time with Vanguard. And so the question is this something that can be evolved for others? Can it work for others? And is it beneficial enough to continue to pursue it? My sense is it's a matter of time, solving issues. There will be compromises, there will be limitations, but it's a matter of time. As to how much time, it really depends on how willing the staff is to engage and how aggressively the marketplace pushes for it.
Yeah, and if it's not evident, any of us at any of our firms, we're all happy to have conversations, engage a dialogue, talk to you through the pros and cons one by one. So please reach out to any of us for more information. We'd love to engage. Morrison, I'll sort of bring this up and you can comment on it. You mentioned a few of the new and novel structures we've dealt with over the last, decade here at the exchange. So you mentioned semi-transparent. I mean, we even started with active ETFs, but let's talk more recent. Semi-transparent, spot Bitcoin, futures Bitcoin, now spot Ether. It seems like we've followed a certain fact pattern, which is the SEC has historically gathered all the filings for that particular item. At some point, we never know when, but at some point the window closes where they've said, okay, all new filers have to wait. We're going to work with the ones that we have on record. So if you want to be in that dialogue, in assuming we follow the same fact pattern, you'd want to have an application in so that you're in the dialogue, because then you're helping influence the way things may or may not turn out. And then when the window finally opens and those firms receive approval, you're now getting in line for your own approval process, which then potentially delays launch by, who knows, months, year, whatever the case may be. Do you think we follow a somewhat similar structure? I know you're sort of putting finger to the wind, but is that what you would expect?
It's a rational way to cope with it, and we've seen examples of late. For instance, the spot Bitcoin funds, obviously there were a ton of filings, 19B4 applications and S1 filings. The staff looking for fairness, trying to gate the approval of those items, sort of gathered those that were ready to go at a given point and released them to go. I think semi-transparent, similar as with Ether and spot Ether, same things happening currently, right, in terms of the approvals. And so it's a rational way to cope with what the SEC has to deal with, which is consider a range of applications. They're different. Try to reach a consensus, at least at the SEC, as to what's appropriate, and then grant those applications for those first in. After that, there can be those that are doing things differently or want to consider other avenues. But the first group in may set the tone for what ultimately is initially approved.
Thank you. Another question, I'll try and tackle this one since it's an exchange question, and then we'll hit the distribution topic. Again, thank you for all the live questions. Another exchange filed for listing rules for multi-share class ETFs. Does that help? The reason New York Stock Exchange hasn't filed for anything is because we don't need to. We already list multi-share class ETFs, as we've talked about earlier with the Vanguard lineup. And when we started listing ETFs directly on the floor, not just on ARCA, but on the floor with humans, we copycatted those rules down to the floor. So if tomorrow everyone received approval for multi-share class ETFs, New York Stock Exchange is ready to go. No filing needed. So give us a call. We're happy to walk you through that if you want to go more in depth. Let's turn and hit. We've got a handful of questions around distribution. How might distribution change? Viewpoints on clones. There's a lot in here. Ben, could I come to you and maybe start to tackle how firms might want to think about distribution in terms of multi-share class, standalones, doing a conversion, et cetera?
Yeah, it's great. It's a meaty topic. Try to tackle a few things there. So certainly, I think the answer to that question certainly depends if you're in the ETF business today or you're not. And certainly those who are new entrants or would use this as a path to entry into the market certainly have, several considerations from a distribution standpoint, to retool their marketing and distribution engine or operation behind the scenes to really be able to compete in the ETF market. Again, it's just a different animal, obviously, as many on this call know, in terms of how those products are marketed and sold. And, there are different successful models out there, but certainly it takes a pivot, and ultimately ranging from, again, getting specialists in the door to being able to, ingest data to be able to track those sales and help compensate distribution and sales teams. I think this issue of clones is an interesting one. That's always a thorny issue that comes up many times. And we've really seen clients do really a couple different things. Certainly many have tried to sidestep that issue, being, having a mutual fund lineup and then launching an ETF suite that is really more fit for purpose and substantially different from those mutual funds, and then go out and market those. Then on the flip side, certainly, there are some areas where clients have tried to, and you see lots of examples in the market of those who've tried to, launch effectively a nuanced or a tweaked version of a strategy. Again, trying to sidestep the issue to some degree to allow both the fund and the ETF to exist on the platform. A lot of that is driven by fees, but there are other considerations as well. So I think all of that would likely be in play here for a scenario where there'll be multiple ETF share classes, sort of proliferating across the industry. I think fees are going to be a big driver of how that works. But also certainly the view that the platforms and the various distribution channels are going to take on this. But again, it's going to be something that's going to be a very important consideration in terms of how the managers approach this topic. And I think distribution alongside the investment content itself is going to be a key driver in terms of what's the best path forward for a lot of asset managers who are looking to avail themselves of a share class.
Yeah, and as evidenced by the amount of topics we're trying to cover, when we prepped for this, we talked through a lot of things. Please reach out to any of us individually. We're happy to go deeper on any of these topics. Jeff, maybe one final piece, because we got another question in on what Tim referenced to was switches. So the idea that you're in one share class, you want to move to the ETF share class once you're live. Would you maybe, if you wanted to, maybe dig a little deeper on that process, pros, cons, or if there's any other comments just while we have the remaining minutes here on any of the other topics?
Sure. So on switches first, and I'll touch one more. So for switches, I think there are obvious benefits, right? If you're a long-term shareholder, but you really want to own the ETF instead of a mutual fund, you love the strategy. This is a way to do that where it's a tax-efficient move. So no impact to existing shareholders that are in the mutual fund that you're vacating and jumping into the ETF share class. So it's a positive, and it's an exit strategy for shareholders like that to switch between the two classes. I say the con, if there is one, is that you need dance partners to make this happen. Right? Remember, ETFs, they're not held in the fund; they're held in brokerage accounts. So you need all of these individual brokerage houses to actually play ball and have a process to allow you to do that switch. So today, like the one manager that we all talk about today that has this structure, they have captive brokerage internally. So it's not hard for them to do a lot of this. And they have piped into some others, but it's getting everybody under the tent to kind of make sure that switches can function as efficiently as they have. Last point I'll make, and then I'll hand it back. So Morrison and Doug, you guys did a great job of explaining kind of the why file. The one thing I do want to make clear is, like, I've heard a couple of conversations with firms where they've said, yeah, we need to file because we want to do all of those things that everyone's always done with all the other innovations, right? Whether it's starting to build track record as fast as you can, trying to get to scale as fast as you can, trying to take advantage of first mover advantage, which none of those apply here from my perspective, right? You have a legacy product that's at scale. You have a legacy product that has track record, and this isn't strategy specific. So there really isn't a first mover advantage because there's strategies you have today. Now, that said, I do see a benefit if you're a product where it's like more of a protection play where you're in outflows, because I think the facts and the direction of travel of flows have proven that outflows are flowing out of mutual funds into ETFs. So if you look at the mutual fund to ETF conversions, in most cases, maybe some haven't grown, but they've definitely stemmed outflows. So if you're looking to stem outflows, that's another reason to file faster than later.
All right, perfect. Now, for those that weren't watching the clock, we are out of time. For those asking about this, yes, it's being recorded. Yes, we will host it at etfcentral.com like we do all of our other webinars. And yes, if you're a certified ETF advisor, you will get CE credit for this. If you are not yet a certified ETF advisor, please go to etfcentral.com, click on the ETF Institute. You'll find out everything about it. It will bring your knowledge level up to where it needs to be to cover this industry. Now, as mentioned, all of us are available one-on-one or together. We're happy to follow up any of this conversation. Please reach out to us. I want to thank everyone for your time joining. I want to thank all of the distinguished members on my panel. Thanks for joining us for another ETF educational opportunity brought to you by the New York Stock Exchange, the home of ETFs.